Welcome to the Explainer. Today, we're digging into a pretty fascinating theory that connects the U.S. Treasury's day-to-day cash management with the upcoming November election. Okay, so let's just jump right in. If you've been keeping an eye on your portfolio, you've probably noticed things have been a bit shaky lately, right? It's not just your imagination. Things have been looking pretty rough across the board. I mean, just look at Bitcoin. Since it peaked back in September 2025, it's taken an absolute nosedive, a staggering 45%. A whole lot of value just gone. And hey, it's not just the crypto world. Even the powerhouse Nasdaq is down 6% from its high in October 2025. A lot of investors are just feeling, well, stuck. And even gold, the classic safe haven asset, well, it couldn't hold on forever. It finally cracked, dropping 9% in early February 2026. It really feels like nowhere has been safe from this downturn. So what on earth is going on? Is this just the market being the market? Well, according to one analyst's take on all this data, this isn't random at all. It might be something way more calculated. And here's the claim. The theory is that the Treasury is deliberately sucking money out of the financial system right now, causing this slump, all as part of a bigger plan to flood it back in at the perfect political moment. Now, to get your head around how that could even be possible, you gotta understand the government's main financial weapon, its own bank account. It's called the Treasury General Account, or TGA. The easiest way to think about it is like the government's checking account. And here's the key. When that account's balance goes up, it's because money is being pulled out of the regular financial system and into the government's wallet. And this is how they do it. The Treasury sells a ton of bonds. The private market, banks, investors, you name it, buys those bonds with their cash. And where does that cash go? Straight into the TGA. It's literally like a giant vacuum cleaner sucking up all this cash that could have been flowing into stocks or crypto. And that is exactly what we saw happen. Right after the debt limit was raised back in July of 2025, the Treasury just went on this massive borrowing spree. Its cash balance, the TGA, just shot through the roof, from about $300 billion to nearly $1 trillion. And that happened in just a few short months. Which brings us right back to the heart of this whole theory. That giant pile of cash isn't just for emergencies. The argument is that it's being hoarded on purpose, like ammunition, ready to be fired off later this year. Okay, now this is where it gets really, really interesting. This comes directly from the Treasury's own statement on February 4th. They literally published their game plan. They said they're going to keep building up this cash pile until it peaks at over $1 trillion in late April. And then, and this is the crucial part, they're going to start bringing that balance down in May. So you have to ask, right? Why May? Why go through all of the trouble of draining the markets for months just to turn the taps back on and start releasing all that cash 6 months before a major election? Well, the theory goes that it all comes down to how important the stock market is to American voters. In a lot of other places, people's wealth is tied up in real estate. But in the U.S., so much of our retirement, our 401ks, it's all in the market. And when the market's up, voters just feel better. They feel richer, more optimistic. And of course, timing is everything. A market rally in February? Nobody remembers that come November. But a nice, strong market pump through the summer and into the fall? Wow! That could really move the needle on how people feel right as they're heading to the polls. All right, so let's put this all on a timeline. Let's map out exactly how this alleged strategy is supposed to work, from beginning to end. Okay, so here it is. The whole thing kicks off when the debt ceiling is raised. Then, in the fall, that liquidity drain really starts to bite, causing the drops in assets we talked about. The government keeps hoarding cash until it hits its peak in April. And then, starting in May, the floodgates open. The government starts spending that cash back into the economy, releasing that liquidity, and aiming for a market peak right around Election Day. And the timing gets even more specific. Think about this. What happens on April 15th every year? Tax day. A massive amount of cash gets sucked out of the system to pay taxes. So the plan seems to be, let that final squeeze happen, and then start injecting the cash back in. According to the theory, that makes the rebound effect even more powerful. So that brings us to the big question, the final takeaway from digging into all this. We've seen the markets tank, we understand the TGA mechanism, and we've even seen the Treasury's own official timeline. So what is this? Is it a masterful, cynical, political plan to time a market rally perfectly for an election? Or
Is it just the government doing its job, managing its books responsibly, and the timing just happens to be a wild coincidence? Based on what we've seen, that's really the trillion-dollar question, isn't it?